Hi, I'm Jake Honeycutt, and welcome to Honeycutt Investment TV. In this episode, we're going to be talking about natural gas E&Ps. I think the natural gas E&P sector is an extremely attractive area of investment for long-term investors right now, and there are three big reasons for that. Depressed valuations. A lot of these companies in this space are now selling at multi-year lows. They're selling at multiples that are very low based on their proven reserves as well. The second big reason is I think there are huge macro tailwinds in this sector. I think demand will increase in this sector over the next decade significantly. And the third big reason is the cost of production are falling for these companies, and a lot of that's related to the volume gain. Now, I'm looking for high quality natural gas E&P companies. I don't think this is like throwing a dart at a board. I think you need to focus on high quality companies to do well in this sector over the long term. So I'm looking for companies with specific attributes. The biggest one is a low cost of production. That's absolutely vital, particularly with natural gas prices as low as they are right now. The second is I want companies with strong balance sheets, or they have some sort of strategy like a hedging strategy that is very beneficial to them. And a third attribute I'm really looking for is assets weighted towards natural gas over oil. Now let's take a look at prices real quick, and this is the Henry Hub spot price, and it's inflation adjusted. And as you can see, natural gas is now near a multi-decade low. And that always grabs my attention when I see stuff like that. Let's take a look at Citygate prices real quick too, and those are under around $4 now. It's a little bit delayed, but it's probably about under 4 now, and the Henry Hub was below 3. So these are very low prices. All right, so let's take a look at some of those macro tailwinds for natural gas, and I think there's 3 big factors here. The first is increasing natural gas exports, and we can divide this into 2 little subcategories. The first is LNG exports. That means liquefied natural gas. This is a heavily regulated sphere in the U.S., but we're seeing companies build the infrastructure to do this, and basically they would be exporting liquefied natural gas to places like Latin America, Europe, India. And we could see natural gas demand here in the U.S. rise significantly as a result of these LNG exports. Now, LNG exports have some controversy surrounding them, so that's something to factor in as well. However, there's another area that's often overlooked, and that is exports to Mexico. Mexico deregulated its energy markets, I think in 2013, and since that time, U.S. natural gas exports to Mexico have increased significantly. So even without the LNG exports, we could see significant demand increase from places like Mexico as well. The second potential macro tailwind for natural gas is electric vehicles. Electric vehicles are a very small part of the U.S. auto market right now, but the technology is improving rapidly. If in 10 years electric vehicles are even 10 to 20% of the auto market, that's going to increase demand for electric power. And increased demand for electric power means increased demand for natural gas. Of course, on the other side of the equation, it's not necessarily going to be good for oil. So there's that to factor in as well. Third macro tailwind is one that's really been ongoing since about 2008, and that is natural gas is displacing coal as the U.S.'s primary energy source. And this is just because natural gas prices have fallen so much that now natural gas is a lot cheaper than coal. And from an environmental perspective, it's also a cleaner energy source. So there's a lot of reasons why natural gas is slowly displacing coal, and that trend's probably going to continue in the future. Now I want to take a look at one producer in particular, and that's Range Resources, and I want to show how they exemplify the trend in this sector. So this is a production chart for Range Resources, and you can see how their production has dramatically increased since 2007. Now, this is interesting because the volume gains have resulted in lower production costs. So here's the production cost chart. This is all in production costs. This includes things like depletion expenses, interest expense, G&A expenses. And you can see that the price per 1,000 cubic feet equivalent of gas has fallen from 452 in 2010 to 266 in 2014. So that's a pretty big decline. And that is a trend that's been going on throughout this sector. Now, overall, after examining this sector and doing a lot of research, I don't think natural gas prices will stay this low in the long term. While production costs are falling, the current plunge in prices I don't think sustainable. I think if it persists for more than 6 months, what we'll see is production cuts in the sector, and then we'll likely see future price increases after that. Overall, I really think the natural gas E&P sector is just extremely attractive right now. There are 4 companies I really like in this sector: Range Resources, Antero Resources, Ultra Petroleum, and Cabot Oil and Gas. There are probably a few others in the sector. Those are the 4 I've really focused on researching them. All right, thanks for watching. Check out our next video, which is going to be on Range Resources.